My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. I love reading your emails. I love seeing how different people view this topic of dividend growth investing. My portfolio is very unique and specific to my wife and I's goals of retiring early. The type of investments that I have in here, if I was in my early 20s and I had a 30-year time horizon, meaning I wasn't going to live off the dividend income in the next 30 years, I would invest very differently than I do today. And that's very, very important that you understand that. If you're brand new to investing, the last thing that you want to do is go on YouTube, see what somebody else is doing, adopt that strategy entirely and blindly, and think you're on the right track. Because a lot of people do that. They don't understand the concept of how to invest based off of your time horizon, because that's really what it ultimately comes down to. It's all about picking the right investment with the right dividend yield, with the right growth rate. And that might seem a little bit intimidating if you're hearing that for the first time, but I promise you it's one of those things, once the light bulb turns on and it clicks, it's like, okay, it makes sense. But yeah, if you're new to the channel, I've been doing this Review My Pie for the last couple of years. I love talking about dividend growth investing. In fact, my wife and I, we just barely reached Barista Fire here this year, where we're working part-time and also living off of our dividend portfolio. So I'm really excited about that. It's been a really interesting transition this year from working full-time to not really working at all, in terms of a 9-to-5 job. And it's been a really great experience. But I will say there's been one phenomenon that I will say I didn't really see coming. And that is that it's a lot harder to wake up when you don't have to jump in that 8 o'clock meeting or when you have to go and drive in traffic. So this has been me these last couple of months. So in today's video, like usual, what we're gonna do is we're gonna look at a subscriber question. The question is from a 39-year-old here in the US. Then we're gonna take a look at 3 portfolios. The first is gonna be from a 21-year-old here in the US. The second, a 32-year-old from Canada. And then the third, a 36-year-old from the United States. I'll leave the timestamps in the description below, as well as the portfolio links. And as always, everybody, I don't review the portfolios beforehand, so I'm looking at them for the very first time. So I want to keep it as authentic as I can. I don't want to script anything. And as always, everybody, I'm not a financial advisor. Please don't take what I'm saying as financial advice. It's just merely for your entertainment. And speaking of entertainment, did you all watch the speech from Jerome Powell last week at Jackson Hole? That was pretty interesting. It's always interesting to see, the market, how it reacts before the speech, during the speech, and afterwards. Needless to say, it was a pretty big roller coaster. I mean, this time, nothing really changed, but it had everybody at the edge of their seat like, oh, is he going to say something? Is he going to cut rates? Is he going to raise rates? What's happening? Like everything, depends on the words of this one dude. But yeah, watching the speech from Jerome Powell, it kind of felt a little like this.
It's my crystal ball.
It looks like a snow globe.
Nuh-uh, it's real. Here, watch. Free Doritos at the office today? I think that's a yes!
We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate, and intend to hold policy at a restrictive level.
Oh my gosh, I love it. I love it. Oh man. All right, cool. So here, before we dive into the first portfolio, I just wanted to share with all of you, I created a DGI Defy community. This is my own private community here with all of you. We just had our first virtual meetup last Sunday. It was a lot of fun. It was great meeting different people from, different backgrounds when it comes to, dividend investing. And I'd like to invite you to join if you're interested in joining the community. We can talk about your portfolio. So here, this last month, we did the, kind of a quick round of introductions. It was recorded, so if you want to join, you'll have access to that. But in the next virtual meeting here this month in September, we're going to do more of a Review My Pie kind of video where we're going to go through everybody's portfolio. And if you want to be part of that group and part of that community, it's pretty tight knit. It's not a big, large Discord community or anything like that. It's a pretty small community, but it's great because it's very personal. We also have a WhatsApp group where if you have any questions, you can, ask the group directly. I respond respond directly. Others in the group respond directly. And we have different topics that we talk about. But I definitely wanted to invite you to join or consider joining. And it'd be great to have you there and to, to see you there. So if you want to review your pie with the group there, you can join here, the DGI Defy community. I'll leave a link in the description below. There's two ways that you can join. One is through the join button, through the memberships on the web, on YouTube, and also through nos.io. You'll see it in the link below. Be really cool to have you join. All right, let's take a look at this question. This question is a little bit older from a few months ago, but I think it's still an interesting question. It was titled, How to Start with Dividend Investing. So the person right here, Murtaza, writes, Hello, Jake. Thank you for your dividend information series you have started. I recently subscribed and I've gone through the videos and love them. Thank you so much. I really, really appreciate it. I know you said that you've been giving yourself 8 to 10 years to live completely off your dividends, and I wanted to do the same. I have about 200 to 300K that I can invest now into dividend stocks, but there's so many options out there. It's extremely confusing and scary at the same time. I want to invest into high dividend stocks that provide 10% or more. Then I can hear but then I hear those aren't good investments for the long term. My current age is 39 years old, and my end goal is to make $10,000 to $12,000 a month by the age of 45 to 50. How would someone like me start, and how much funds I'll need to reach this goal? I also looked into Fundrise, but I don't want to put all my money onto this. What do you think about Fundrise? I'd appreciate it if you could share your opinions and suggestions for someone like me on a great journey of dividends and passive income. All right, isn't that the best? Passive income and dividends. All right, cool. So there's a couple things here. First thing I want to talk about is Fundrise. I looked into Fundrise in the past. I absolutely didn't like Fundrise. And really what it came down to was liquidity. The fees that they charge, it's very difficult. It's illiquid. It's hard to get your money. If you do invest in a Fundrise, it's fine. It's kind of a set it and forget it. That's absolutely fine. But for me personally, I much prefer REITs, real estate investment trusts. And especially if you're looking to build wealth, like actually build wealth, look at investing into actual physical real estate. Look to how you can house hack. You're going to get a lot more bang for your buck that way. There's a lot more work involved, hence why you're getting a bigger bang for your buck. And it can be a lot more stressful. But in my opinion and in my experience, that's how I built my wealth. I didn't build my wealth selling courses on YouTube. I built my wealth from going to college for almost 7 years and investing into real estate and working my butt off, working 6-7 days a week. Now, that's not for everyone, right? And I did that because I wanted to retire in a very short period of time. And if I didn't, I would have, instead of retiring in 7 years, it would have probably taken me 10 or 12 years. But for me, my wife and I, we prioritized doing it quicker, sooner, because that was just who we were, what we wanted to do. When you're thinking about starting dividend investing, if you have about a 10 to 15 year time horizon, you really want to focus on growth. You don't want to go after those big high yielding yield traps, those mortgage REITs, right, that are paying 12, 15%. You want to focus on an investment that has a very good balance of current yield and dividend growth. Now you might be asking yourself, well, Jake, what is that magical thing? Well, I'm not Dave Ramsey. I'm not going to tell you some arbitrary number to go after and just figure it out yourself. I'm actually going to show you and tell you how I did it. So in my opinion, if you have a 15-year time horizon, if you haven't seen my other videos on how to invest based off your time horizon, I'll leave a link at the end of this video to that video. You can check out that. But really what I would look at is I'd look for an investment with a 10 to 15-year time horizon, an investment that's yielding around 3.5 to 4.5% starting dividend yield with an average of 7 to 10% dividend growth. And that's what I would focus on. And I wouldn't try to over-engineer things. I would focus on getting the basics right. And the basics for me is the simple path to wealth with maxing out as much as you can each month into your portfolio, as much as you're able to without living in poverty and living off of top ramen, right? You want to make sure that the journey is enjoyable. You don't want to sacrifice everything, right? Still want to have a little bit of fun. In order to retire early and to reach your goal of 10 to 12K in dividend income by the age of 45 and 50, you're going to need to invest a lot of money. There's no getting around it. It takes money to make money, surprise. But you want to make sure that you're not overcomplicating it. And What I like to do is I like focusing on the simple path to wealth. That's SCHD combined with DGRO. I've been talking about this for almost a year. That's what I focus on. Have that as your core. And then, 10 to 20 to maybe 30% you could have in other ETFs or spread out across individual stocks that are yielding a little bit higher to get your overall yield up. And then from there, I would kind of tweak it and focus on that. So I shared a lot of, kind of technical information there. The most important thing that you want to focus on here is you want to understand what is your goal. How do you want to have this set up? Because the worst thing that you can do is start just blindly and make mistakes and then kind of have to start over. So I would put together a plan. I would focus on high quality ETFs as your core, put together a strategy, automate your investing, and enjoy your life for the next 10 to 15 years while you're working hard and working towards that goal. And, there's so many more things that I could go into and share, how I did it, how I was able to increase my income through investing into real estate. Now that sounds kind of, it sounds like a infomercial, how I did it, but there's many different ways that you can do it. Okay. And so I would look at what you're good at and what's going to be the best for you in your particular situation, because everyone's in a unique situation with a different set of skills. And that's what I would focus on, is making sure that you're getting the basics right. Thank you so much for sending over your question here. All right, the first portfolio is from Nigel. He writes, "Hello, Jake. My name is Nigel. I'm 21 years old and in Maryland. I've been a subscriber for some time now and appreciate watching your portfolio reviews. I also wanted to get a second opinion on mine. So after watching more of your recent videos, I created a portfolio. I aim to reach 5K a month in dividend income within the next 15 years. My targets are to include ETFs as my core, along with monthly dividend companies." Okay. "My portfolio also contains a couple of companies I think are good long-term holds, and they also pay dividends. Some companies are a little more risky, while others are safer. I'd like for you to take a look at my portfolio and determine if you believe my portfolio is over-diversified or under-diversified. If so, what are some ETFs you think would be, the best fit? Would you consider my target as realistic?" Okay, well, Nigel, thank you so much, man. I appreciate the question. I appreciate you sending over the portfolio. One thing that I do want to make sure that you understand, when you think about investing, when you think about risk, you want to make sure that you define what is risk for you. Is risk, a company cutting their dividend? Is risk a company going, bankrupt? What is risk? And what is safe versus not safe? Are you talking about volatility? Because that word risk kind of gets thrown around, and safe gets thrown around as well. You want to define what is risk and what is safe for you personally. Okay. And so a lot of times when we think about risk, it's about, a stock going to zero or the volatility in the stock, right? So just make sure that you understand that piece. In terms of, 15 years, anything is possible, right? It depends on, where you're starting from and how much you're investing every single month. If you want to retire in 15 years, it's going to require you to be different and invest a lot more than somebody who's maybe investing a lot less, but has a 30-year or a 40-year time horizon. If you want to live differently, then you have to be different and you have to do things differently. Let's take a look at your portfolio. Let's see here. So the chart is not showing, for whatever reason, this is not working in M1. But let's see here. You got 43 holdings. You have a really, really high dividend yield and a decent, this is not a bad expense ratio. So you probably got some covered call ETFs in here or some monthly ETFs in here that are paid. They charge a little bit more. First off, you don't need this high dividend yield. So this is the first thing. If you're 21, you don't need a 6% dividend yield, right? What you'll probably want is somewhere closer to a 3.5 to 4.5% dividend yield. Once again, if you don't understand that, watch my video after this, the how to invest based off of your time horizon. That will help you understand that. You don't need a high dividend yield because you're paying taxes, you're getting a lower total return, and it's just not efficient. Okay, dividends, just because it pays a high dividend doesn't mean it's the right investment for you. And especially if you're younger and you know that you have a 15-year time horizon, you don't want the juicy yield now, because it's inefficient, okay? That's really, really important that you understand that. Okay, so let's take a look. What do you got in here? You got a lot of 1%. Okay, a lot of 1%. Let's see here. So you got VTI. I like VTI. It's going to be difficult to live off the dividend alone, but I like VTI as broad diversification. You got energy. Energy. Okay. I think you're like the only 21-year-old that I know of who invests in energy. My dad is like 72 and he invests into energy. So that should tell you something. Okay. JebQ, I like JebQ, but it's not something that you want to invest in today and dollar cost average into today. You want to add it later because you're going to get more value somewhere else and you're not going to pay a high dividend, right? So that's what it comes down to, being efficient. This is not efficient, okay? So, and you don't have to overcomplicate this to make it efficient. You got VNQ in here. I like that you only have it at 5%. You got VYM, you got SHD, you got RYLD. So RYLD and JebQ, these are covered call ETFs. They're kind of in the same boat. In my opinion, me personally, I would take them entirely out and then consider adding them later because you don't need to have them now, right? Yes, your dividend yield will go down, but that's a good thing. You don't want to pay the dividend. You don't want to pay taxes now. Why? Right? Even if it's in a tax advantaged account like a Roth IRA, you're capping the upside. You have to understand what these covered call ETFs are. You got energy. You got 10% energy, man. I'm not a fan of that because you're getting energy in VYM and SCHD. Why do you want extra exposure to energy? Why do you want to pay extra in taxes? And why do you want to likely have a lower total return over the next 15 years? Doesn't make a lot of sense. Now, obviously, I don't have a crystal ball. Past performance is not a guarantee of future performance. It's just how these asset classes work. Energy is not going to grow as fast as a consumer discretionary or a growth company or growth sector, right? So something to be aware of. JEPI, same thing. These covered call ETFs, get them out. Devo's a little bit different, but it's still a covered call ETF. You don't need it. Take it out. Take it out and consider adding it later. Stag 1, 2, 3, 4, 5, 6, 7, 8. 8. You have 8 companies in here that are REITs. I'm not the biggest fan of that because once again, it comes back to tax efficiency. It's not efficient. It's not tax efficient. So what I would recommend, this would be perfect if we were on a call one-on-one or, in the group. I could sit you down and say, hey, Nigel, let's break this apart. This is not going to work because of the following reasons. And you can kind of go back and forth of why. But let me tell you, ideally, it would be much more efficient to replace these REITs, at least for now, into something like McDonald's or Pepsi or something similar, right? That is growing faster. You're not getting taxed a non-qualified dividend in these, and you're going to get a higher return over the next 15 years. VC may be a little bit different because it's a growth REIT. Let me show you. I've done this before. Let me show you just to reiterate what I'm talking about here. Let's say, for example, in 15 years, let's say you have $1 million. You got $1 million. You're like, man, Mom, I made it. I'm retired at 36, right? And you say, I made $1 million. You're probably going to need more by like 2 or 3 by then, but let's use just $1 million. $1 million is a lot of money. Okay. So let's say you have $1 million portfolio and you have 1% in a Coca-Cola. Okay. So you're going to do times 0.1. That means in 15 years, you've worked your butt off and you finally made it. You have $10,000 invested into Coca-Cola. Yeehaw. Okay. Now let's say you're getting your 3% dividend yield from Coca-Cola. That means you're getting $300 a year, or for 4 quarters, you get $75 every single, quarter. Okay. It's not a lot of money. It doesn't make a lot of sense, in my opinion, to have like 30 companies at 1% because you're only getting pennies. You're not getting hardly anything. Let's use another example with Apple. Apple's kind of unique. You don't always look at it for the dividend necessarily. It's more for the total return. But let's say you get 1% into Apple, you're invested $10,000. Awesome. Okay. And then what you're going to do is you're going to times that by the dividend. The dividend is not even 1%. That means on a yearly basis, you're getting $75 from Apple. Divide that by 4. You're not even getting $20 a quarter from Apple. And so the reason why I'm sharing this is, are you really a shareholder of these companies if you're only getting a couple of dollars in dividends per year, even after you've worked for the last 15 years? So in my opinion, I would condense this. I'd probably cut this in 1/3. I'd keep 1/3 of this personally. I would consider trimming, if not removing the REITs entirely, and then adding them later, right? You don't have to add them now from day one. You could add them later. You said you have 15 years. Why not focus on growth, focus on what's going to give you the highest total return over the next 10 years, and then 5 years before you reasonably know that you're going to retire early, then you start adding these others where you're going to be paying a little bit more in taxes, but you have a clearer sight of what your retirement will look like. Right now, this is not how I would set it up for a 15-year time horizon. Okay, so the covered call ETFs, get rid of them entirely. I personally, in my opinion, for a portfolio like this for you, or for anyone in a similar situation, what I personally believe that you should probably have 70 or 80% into your core ETFs. 70 or 80%. 70 or 80% split up between SEHD, DGRO, something similar, and then the rest you build out and you support your core SEHD and DGRO. If you want more growth, you focus more on growth. If you're closer to retirement, you focus on a higher dividend. For example, really quick, I know I'm talking a little bit long on this one. Let's say with 80% into SEHD and DGRO, then what you could do if you have 5 years to retire, then what you could do is you could add JEPQ, JEPI, Altria Group, and BTI at a higher percentage. But let's say you have 25 years or 15 years, then you would add more Nike, Costco, companies that are growing faster, Apple. So it's really, really important that you understand that and you have a plan and you're not just kind of at random setting this up. Nigel, I hope that helps. Thanks for sending over your portfolio. All right, the next portfolio is from Steve. He writes, "Hi, Steve. Please hide my email address." Okay, great job on the channel, entertaining education. Enjoy watching it. Wish your family all the best. Thank you, Steve. Appreciate you saying that. I was hoping you could review my portfolio and provide comments. I provided some background info below. Thanks. All right, so let's take a look at your background. You're married. You're 32 years old. You're a CPA. Very cool. You live in Canada. You work for a wealth management firm. You bought a house with a mortgage of $410K remaining with 25 years. Real estate is expensive here. Oh, it's very expensive. I know Canada's really known for, there's a lot of real estate investors up in Canada. You earn a stable income of $90K per year, not counting an annual bonus or annual increases, and a retirement of $5K match per year. Okay, you got household income. My wife and I was around $170K. No children. Probably will have one or two in a couple of years. So your portfolio, you have $90K invested among different tax advantage deferred accounts through your work. These are mostly in Canadian bank and other dividend paying stocks. My goal is to have 80% invested in these safe dividend paying stocks, and the other 20% will be in a combination of growth and dividend growth stocks, which I will manage for growth, but also for fun. 30K invested in this portfolio. I'd also like you to review, see attached screenshots. You have an emergency fund fully funded. Great. Have around 50K in cash, potential opportunity to buy shares. Okay. I will be contributing $300 to $400 per month for my money for my side hustle bookkeeping to this portfolio, and about $1,000 to $1,200 per month to my retirement portfolio held by work. Your time horizon is 20 to 25 years. Any comments is much appreciated. Keep up the great work. All right. So Steve, thank you so much for sending over the email. It sounds like you're really, you're CPA, so you probably are a little bit more advanced than most who aren't, obviously have studied finance or have a financial background in that sense. But I think, you own a home, you're maxing out or you're investing broadly across different accounts. You're taking advantage of the different local accounts that you have available to you in Canada. Your strategy here, so this is what's kind of interesting for me. So my goal is to have 80% invested into safe dividend paying stocks, and the other 20% will be a combination of growth and dividend growth stocks. So dividend growth stocks. So let's take a look at your portfolio here based off of your allocation. So it looks like you have Apple, Microsoft, Google at the highest. Now, this is if you've been following the channel, you probably already know what I'm going to say because it's so important. You got Microsoft and Apple at 15%, and then you got Google at almost 12%. I don't like this for your average person. Now, is it likely going to be okay? Likely it's probably going to be okay, right? It's probably going to be okay. But in my opinion, why risk so much of your money into so many, into so few single stocks. Even though these are the greatest companies of our generation, I just personally, knowing my history, knowing that times change and consumer behaviors change and things happen, that nothing is guaranteed, right? If you were 100 years ago, you probably thought that coal mining and wheat and corn was the future, right? Like, I just don't know. So for me personally, because I accept that I can't predict the future, I much prefer to invest heavier into ETFs. And I know that everybody says that Warren Buffett does it, Charlie Munger, like, stop it. You're not Charlie Munger, all right? Like, stop comparing yourself to the greatest investors of all time, okay? So you're not Warren Buffett, okay? But what you could consider, what I personally would be much more comfortable with, is if you want that high of exposure to Microsoft and Apple, why not consider a sector ETF like VGT? VGT has a huge disproportionate weighting to Apple and Microsoft. That may be something to consider. In fact, I own VGT in my Roth IRA, my retirement account. I much prefer, if you want higher weighting to a single stock, I much prefer it in a conservative growth ETF like a VGT or a VUG or SPYG. There's a few other ones out there. So that's what I prefer. When it comes to the others here, I think these are great companies. These are great, brands. I don't think they're going to go anywhere anytime soon. It's good. I like them because you can kind of project where the dividend growth will go. With some of these like Visa, Amex, you're going to get a lower starting yield, but you're coupling them with others that have a higher starting yield, like a Texas Instruments, a T. Rowe, for example. Okay, so I like that you're combining it, but the thing that I'm not the biggest fan of is the overexposure. Like, for me, it's like, why? You don't need to. And if a scandal happens, if something happens, like, give you a random example, I'm kind of cherry picking, but look at what happened with Hawaiian Electric. Company's been around since the early 1900s, been paying a dividend for decades and decades. And then out of nowhere, a black swan event happens and it looks like they're almost going to go bankrupt. Okay. The point is, you just don't know. And then for me, it's like, why even risk it? Why? So that's my opinion. I know not everyone's going to agree with me, and that's fine. But I have the microphone and you don't. So that you're going to have to listen to what I say, I guess.
Well, I have a microphone and you don't. So you will listen to every damn word I have to say.
No, but like that's just how I view it. Okay, so. But yeah, Steve, thank you so much for sending over your portfolio. I hope that helps. House hacking, all those other things, like really the key thing that you want to focus on now is how do you make more money? How can you go from living in that one home to maybe renting it out and moving into another home, right? How can you hack your life so that you can, up your income so that you can inject more money into your portfolio? Because that's what it all comes down to. If you want to retire earlier, you either have to lower your expectations on your spending and your expenses, or you have to make more money. It's just how life works. All right, the third portfolio is from Brian. He writes, thank you for your content and insight. I greatly appreciate your feedback and reviewing my portfolio. I'm 36 and living in Alaska with nearly a single income family. My wife stays at home homeschooling our two young boys, 5 and 9, making a little extra on the side. I've been working for the state DOT as a mechanic for 8.5 years, growing my retirement to $250K, paying the expense fee to be hands off, just have them manage it for me aggressively. I have to leave a balance of 700 hours by maintaining my goal of nearly 1,000 hour cap. To call that an emergency, okay, I'm not 100% sure on the hours. I'm not quite sure. So it sounds like you have a growing retirement of $250,000. My brokerage account is only about 1 year young as follows. So you got monthlies, first month. Okay, so you've broken it up by when they pay a dividend. I like this, but yeah, I mean, I actually considered doing this as well. I don't prefer it this way, but I understand your logic behind it. So your monthly dividend stocks or ETFs, you got JEPI in there at 18%. You got Realty Income, you got Maine, and you got Good. Okay. Your first month, you got, so this pays on a, for example, January, April, for example, the first month of the quarter in the calendar year. You got a little bit in Avalon Bay, a little bit into MPW, and a little bit in WPC. You actually sent me another email that I looked at a little bit earlier. You consolidated out of MPW into WPC. Okay, not a bad move considering they just cut their dividend. Darn it, man. I haven't made a video on this, but I'm a little bit disappointed, to be honest, about it, but I'll save that for another video. The second month of the quarter, you got Procter & Gamble and you got Verizon. Okay, the third month you got Kroger, Exxon, Johnson & Johnson, Pepsi, Intel. Man, another dividend cutter, I believe, was Intel, right? Stanley Black & Decker, and you got SCHD. With the rest sitting in cash, waiting to be put to work, as we're relatively young with 20 to 25 years of dividend growth on our side along, although not adding a lot to the portfolio monthly, don't want to be spread too thin while choosing good solid companies for the long term. I originally started JEPI to be a low volatile high yield savings. Wrong move, I know, but as we've all grown our real savings, I've been contemplating consolidating JEPI into SEHD or dividing through the individual companies. Yeah, especially if you have that long, moving it out of JEPI into SEHD, I like that better. You could have it as kind of like an emergency fund, but with savings accounts yielding so much, assuming you're not at a big bank, right? A lot of these other companies like a SoFi, well, you can get like almost 5% yield on your savings. So something to consider. I kind of like that better than the JEPI route of having that as like an emergency fund. As you can see, I have a few real estate companies in here. My father has a few rental properties. Growing up, he had a 12-plex and is still getting paid on selling them nearly 20 years ago. So yeah, I like real estate. I like good as a similar company with a diversified portfolio and a high yield, but I've been pondering consolidating it into so realty income once I am no longer negative 35. Probably fine where, to be very honest and very clear with you, once Good cut their dividend, I sold out of Good and I transitioned it to my other holdings. Usually, like if a company cuts its dividend, especially like how they did it, I don't show any mercy. I usually just move on. I take my losses and move on. I have not yet done that with MPW. I'm still thinking about what I want to do. But yeah, like I said, I'll probably touch on that later. I haven't made a decision yet. But yeah, so does it make sense to try to limit or equal out companies that pay payers for each month? How are we looking? More consolidating? I need to do anything or add anything to get rid of? Lowe's and GPC have been on my radar. Okay, so yeah, in your other email, you did say that you added Lowe's and GPC. While maintaining a heavy weight into SHD, having some solid diversified company holdings. Okay, so a couple of things here. So, I mean, this is really cool. I appreciate you sending the long email. I understand where you're coming from. I understand where you're coming from because I was in your shoes not too long ago. A couple of years ago, I remember spending long nights, rocking out to, Fall Out Boy and my 90s punk music, just listening and working through charts and trying to figure out what's the best approach. I went through an emo, man, I remember, oh my gosh, Taking Back Sun. I'm getting off on a tangent. Anyways, put on some music, go into your spreadsheets, have fun with this, play around with this. But I think, what I came to the conclusion was, first off, I don't want to sacrifice quality just because a company pays on a specific schedule. Okay, so that was the first thing. So, for example, Verizon and Procter & Gamble. Okay, years ago I considered the same thing. Well, okay, I want to spread it out equally. I much prefer focusing on quality as your core, and then balancing out the rest based off of what your needs are. If you have monthly expenses and you know that you're going to need that, well then yeah, you could do something like this, or you could look at a monthly ETF, like, you could look at an SPHD. I don't really promote SPHD, but it's an example. One that I kind of like a little bit better is from Wisdom Tree, the DHS. This is a higher dividend ETF. But what I like personally is I like having 70 or 80% into SHD and DJRO, for your average person, right? Somebody that's not a dividend nerd and that's going to do everything and over-engineer it, right? Just generally speaking. I like concentrating in SHD and DGRO because that's your core. Nobody's going to take your core. That's your core. You set it and you forget it. It's just your coma money. You let it sit there. And then the 20 or 30%, you say, for example, well, Jake, I can't live off of that low dividend. I need more dividend. I need more income. Well, that's where JEPI comes in. That's where JEPQ comes in. That's where Altria Group, BTI, like these higher yielding companies and ETFs, that's how you can polish off the portfolio to get a higher or a lower yield depending on your time horizon. But because you said 20 to 25 years, in my opinion, you shouldn't even be considering Verizon. You shouldn't even be considering JEPI because those are destroying your total returns. What you want is growth over those next 20 to 25 years while you're still working. You want to have a lower tax burden while you're still working these next 20 years. And then a couple of years before you retire, then you start adding these REITs. Then you start adding these cover call ETFs. Why the hell would you want to have them now and make your portfolio completely inefficient? It doesn't mathematically, logically, it doesn't make sense. Emotionally, it may make sense to you, but that's not really what it's really doing. Is maybe emotionally helping you, and I don't want to discount the importance of emotions when it comes to investing, but if you really want to think about this rationally, you want to keep it efficient and focus on a good balance of a starting dividend yield and a dividend growth rate. That's what you want to focus on. And you get that with SEHD and DGRO, and you round it out with the other holdings that you add on top of it. Okay. And that's how I would look at it. I would stay away from this. Like this, I tried this for about a year. It didn't work. Get away from this mindset. Don't think about it this way. If you absolutely need that dividend income, a couple of years before you retire, add JEPI, add JEPQ as an example, add DHS, these monthly dividend ETFs, and add a realty income, pays a monthly dividend. That's how you can get it. Okay. And that's how I much, much prefer it than trying to, over-engineer it in this way. Okay. So I would recommend going back to the drawing board, kind of figuring out what's a priority of yours, what makes the most sense, and how it's going to be the easiest for you so that you can stick with this for the next 20 to 25 years. The hardest part about investing is putting together a plan, but that's only half the battle. The hardest part is sticking with it over the next 20 to 25 years. Spoiler, it's supposed to be boring. It's not supposed to be something that you fiddle with and you change and you re-engineer every couple of weeks, every year. If you set this up correctly, you only have to look at your portfolio maybe once a year. And that's what I would encourage you to do. Don't try to over-engineer this because it's like, who said this? Was this Warren Buffett? Or can't remember who, I think it was Warren Buffett. The more you fiddle with your soap, the smaller it gets, right? The more you touch it, touch it, generally the smaller your portfolio is going to get. So set it up in a way that you don't have to look at it every single week, that you can just set it on autopilot. Brian, I hope that was helpful. Thank you so much for sending over your portfolio. Thanks for watching, everybody. I hope that the video was helpful. I hope that you would consider joining the DGIdify community. The link's in the description below. Hoping to see you there, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.